Today, to the moon and beyond, our market update to the 3rd of July 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. The S&P 500 and Nasdaq both ended the week at record highs on Friday, as a stronger jobs report pointed to underlying strength in the US economy and sending US bond yields lower, and of course tech stocks higher. Data showed that US job growth accelerated in June as non-farm payrolls increased by 850,000 jobs, after rising by 538,000 in May, although the unemployment rate rose to 5.9% from 5.8% the previous month. 700,000 jobs had been expected. The two-month tally of more than 1.4 million jobs really seems to put the employment picture back on track, following a disappointing stumble back in April. The latest numbers bring the total jobs recovery from the pandemic losses to 15.6 million. More than 22.3 million Americans were laid off in March and April 2020 amid government-imposed business restrictions, and the total employment level remains 7.13 million below where it was in February 2020, though there are a record 9.3 million job openings. Hospitality continues to be the prime beneficiary of the reopening as workers returned to jobs at bars, restaurants, hotels and the like. Labour shortages are still an issue, but employers seem to be adjusting to the new reality and finding ways to attract workers with higher wages and or sign-on bonuses. The jobless rate increase came even though the labour force participation rate was unchanged at 61.6%. A separate figure that accounts for discouraged workers and those holding part-time jobs for economic reasons fell sharply to 9.8%, with the 0.4 percentage point decline putting the so-called real unemployment rate below 10% for the first time since March 2020. Some of the best nuggets came from below the headline figures though. For instance, the number of people employed part-time for economic reasons fell by 644,000 in June. That's just 1 month, but it's still a solid indication that people are getting back to full-time work as reopening continues. Also, the number of people who said that they were prevented by the pandemic from looking for work fell dramatically to 1.6 million in June from 2.5 million in May. So it feels like COVID is less of a threat to the job market now than it has been for many months. That doesn't mean everything, of course, is perfect. Construction jobs, that's a key indicator in the report, had another soft month with a slight drop. And mining, warehousing and manufacturing jobs also barely moved, and average weekly hours worked in manufacturing fell. However, if Washington's infrastructure plan continues to get traction, maybe we'll see the construction number rise in the future. Also, average hourly wages didn't rise as much as expected. The 0.3% climb in June was short of the 0.4% Wall Street consensus. This probably reflects that around 40% of the jobs added in June were in the leisure and hospitality sector. Nothing wrong with those hotel and restaurant positions, of course, but they do tend to pay a bit less than construction jobs, for example, and could be dragging the wages figure down a bit. From a market perspective, this was an all-out positive jobs report, said Shima Shah, Chief Strategist with Principal Global Investors. The improvement today likely reflects a slight easing of the labour supply constraints that have been holding back the jobs market in recent months, as well as continued momentum from the economic reopening. The MSCI All-Country World Index closed at 725.41, up 0.39% on the day, and the Pan-European Stock 600 index settled 0.26% higher. On Wall Street, the S&P 500 and Nasdaq hit record highs. The Dow Jones Industrial Average rose 0.44% to 34,876, and the S&P 500 gained 0.75% to 4,352, while the Nasdaq Composite added 0.81% to 14,639. But still, there were signs of caution in various corners of the market due to the continuing spread of the COVID-19 Delta variant and concerns over a potentially more hawkish Fed. The benchmark 10-year yield was down 3.9 basis points to 1.4407%. Gold edged higher to close out the week. Spot gold prices rose 0.27% to $1,781 an ounce. The dollar index fell 0.4% to 92.222. I think the market is torn between whether to price in the market outlook or the Fed reaction, said Priya Misra, head of global rate strategy for DD Securities in New York. While prospects of a strong economic recovery underpinned equity markets, investors remain nervous that a sharp recovery from the pandemic could boost inflation to an uncontrollable level for the Fed. The expected increase in the wages will likely boost inflation and may lead to the tightening of its monetary policy sooner than expected. If this trend does materialise, this will be a key factor that will mean inflation stays elevated for even longer. We believe headline inflation will stay above 4% well into 2022 and take the view that it is increasingly probable the Federal Reserve will end up raising interest rates in 2022, ING said. Former US Treasury Secretary Lawrence Summers has said massive US fiscal spending will set off inflationary pressure not seen in a generation. Others argue that until wage pressures return in force, a return to 1970s style inflation is unlikely. OPEC Plus resumes talks on raising oil output a day after the United Arab Emirates blocked a deal. The standoff could delay plans to pump more oil through to the end of the year to cool prices that have soared to a 2.5-year high. Oil prices ended the week mixed, with US crude settling down 7 cents or 0.09%. In the shorter term, next week is a bit of a sparse one from a data standpoint, and the market is closed on Monday for the July the 4th Independent Day holiday. The big event next week could be the Fed minutes from its last meeting, due on Wednesday. Obviously, the Fed didn't have the jobs data when it met, but it did throw a bit of a curved ball when it talked about the possibility of getting more hawkish. The minutes could give us a bit more of a behind-the-scenes view as to what the Fed officials discussed. Over in Europe, passenger data from two popular budget European airlines released on Friday showed a marked increase in travellers in June, providing an encouraging boost to recovery prospects for the travel sector and helping airline stocks higher. Ireland's Ryanair said that it flew 5.3 million people in June 21, up from just 400,000 in the same month a year ago. Wizz Air of Hungary said it had 1.6 million passengers last month, and that's up from 500,000 in June 2020. Shares in both companies are listed in London. Airline stocks did their best to fly higher following encouraging numbers from the sector, said Russ Mould, an analyst at AJ Bell. Wizz Air managed to fill nearly 2/3 of its seats on aircraft in service during June, while Ryanair flew nearly 3 times as many people that month versus May. Shares in Ryanair were up 2.28%, while Wizz Air was up 2.01%, and EasyJet was up 0.57%. Under the circumstances, these are positive numbers. However, the airline business model is built on filling planes near or at capacity and then scooping up extra fees on top of everything from early boarding to storing bags. Mull said the sector needs a continuous flow of people through airports, and ongoing COVID restrictions imposed by various governments around the world mean the industry is still some way off from operating smoothly, he said. The airline news met an altogether mixed day of London trading, with the FTSE down 0.03%, just below flat. Major European stock indices have been also in turbulent mood, as the region has been shaken by mounting concerns over the Delta variant of COVID-19, which has led to the imposition of new travel restrictions across the region. New restrictions include those from Spain, Portugal and Malta on travellers from the UK, where the variant is prevalent. It's been a testing week for investors, with markets experiencing a couple of nasty days, said Mould. Fortunately, US stocks are on track to have recovered all of the week's losses, showing that it can pay to hold your nerve when it comes to investing. Patience is paramount. Mould noted that the FTSE's strength came in large part from pharmaceutical and consumer goods companies. Shares in GlaxoSmithKline settled near flat. The British pharma giant rejected activist investor Elliott Management's proposal made yesterday to shake up its board of directors and began a process that would put the future of its CEO Emma Walmsley in jeopardy. GSK also announced that it had partnered with US group Altacor to develop 2 drugs for the potential treatment of Alzheimer's and other neurodegenerative diseases in a deal worth about $2.2 billion. Informa stocks rose 3.2% after shares in the publishing and the event group were upgraded by investment bank Berenberg. Banks added weight to the FTSE with shares in Barclays down 1.68%, HSBC down 1.58%, Lloyds down 1.67%, and Nat West down 2.17%, all trading more than 1% down. Edinburgh-based Nat West Group is the largest commercial bank in the UK, formerly known as the Royal Bank of Scotland. The group's retail operations are also significant. The UK government still owns close to 55% of the bank, which was bailed out during the financial crisis of 2008-9. In late April, the bank announced Q1 interim management statements. The total income was £2.66 billion, a decline of 16% year-over-year. Operating profit before tax was £946 million, and profit attributable to shareholders amounted to £620 million. In the first quarter of 2020, the respective numbers have been £519 million and £288 million, respectively. Basic EPS also increased by 125% year-over-year. Analysts were overall pleased with the metrics, strength of the balance sheet and earnings jump. Investors have been wondering if the fundamentals could also mean the potential for higher dividends in the months ahead. On the results, CEO Alison Rose said defaults remain low as a result of the UK government support schemes, and there are reasons for optimism with the vaccine programmes progressing at pace and restrictions being eased. However, there is continuing uncertainty for our economy and for many of our customers as a result of COVID-19. Following the release of the Q1 earnings, the stock initially declined about 4%, down to about £1.90, but the shares have been stronger, buoyed by the general optimism regarding the UK economy. The FTSE 100 banks have been on a roll, in fact, through 2021. Overall, they've been growing income and keeping their expenses in check. And as the UK eases its lockdown, investors have been positive on the outlook for the sector. Eurozone government bond yields fell as investors' fears over the rise in COVID-19 cases outweighed strong US data. The German 10-year bond yield, the Eurozone benchmark, dropped to minus 0.24%. That's the lowest since mid-June. The DAX closed up 0.3% to 15,560. In the Asia-Pacific, stocks were mixed on Friday, finding their feet on the first trading day of July. Investors awaited, of course, the US employment data, even as they continued digesting economic data from the US and China. Japan's Nikkei 225 was up 0.27% to 28,783, while South Korea's Kospi inched up just 0.1%. According to data released earlier in the day, the country's consumer price index rose lower than expected 2.4% year-on-year in June. China's Shanghai Composite slid 1.95% to 3,518. The Caixin Purchasing Managers Index, PMI, for June, released on Thursday, was also a lower than expected 51.3. Hong Kong's Hang Seng fell 1.4%, with markets reopening after a holiday. With China's yuan recently touching 3-year highs, along with its central bank's announcement that it's working on a so-called digital yuan, there's been some new speculation that China may at some point challenge the United States' dominance as the global reserve currency. In other words, the currency in which global commodities and financial contracts are denominated. According to data from the IMF, some 60% of cross-border transactions are dollar-denominated, with the euro, yen, and pound rounding out the top 4. The yuan share is about 2%, according to the IMF. But despite its current footprint, several prominent financial minds, including hedge fund titan Ray Dalio, say the yuan's star is about to shine on the international stage. Having a currency that's in high global demand, though, can be a drag on a country's export sector. Considering China's export-heavy manufacturing sector, its trade surplus with the world increased 27% last year to a record $535 billion. It's not something that's likely to happen at the flick of a switch, or digital or otherwise. Elsewhere, Jury's Composite World Container Index increased 4.2%, or $337 to $8,399 per 40-foot container last week, and also remains 346% higher than a year ago. Jury expects rates to remain steady in the coming week. Locally, Australian shares finished the week slightly higher thanks to a solid session on Friday that showed some fight in stocks that struggled during the last financial year. The S&P ASX 200 added 0.6% to 7,308 on Friday, pushing the benchmark index 0.8 points higher over the past 5 days. The blue chip index ended the week less than 0.1% below its level that it began, but is trading 1% off its record closing high achieved in the middle of June. The action on Friday was driven by energy shares, which gained 1.8% as the best performing sector, followed by consumer discretionary shares, which edged 1.3% higher. The best performing company in the index was IDP Education, which added a fifth to its value to lead the market. Blue Bet, a gaming startup, listed on Friday, jumped 84% on opening trade before settling to 55.7% gains on its debut. Shares remain vulnerable to a short-term correction, with possible triggers being the inflation scare and US taper talk, coronavirus Delta variant-related setbacks, and geopolitical risks, said Shane Oliver, chief economist at AMP Capital. The sector reversal on Thursday extended into Friday's trade as travel stocks rebounded. Flight Centre advanced 4.5% to $15.46. Webjet added 4.9% to $5.12, and Qantas rose 3.5% to $4.79. Corporate travel management climbed 2.5% to $21.69. Other heavily sold off stocks from last year were also among Friday's winners, with Nuix up 4.3% to $2.43, A2 Milk up 5.2% to $6.52, and St Barbara Minerals up 3.1% to $1.85. Oil prices continue to rise as the top petroleum exporting companies failed to reach an agreement on supply increases. Energy was the market's best performing sector, with Woodside Petroleum up 3% to $22.96, Viva Energy up 2.4% to $1.95, and Oil Search up 1.3% to $3.86. Shares in Westpac ended flat at $25.64 after revealing it was exposed to a $200 million potential fraud. The bank said a company called Forum Finance was at the centre of a complex potential fraud that involved equipment leasing. It said it was dealing with the situation and had alerted regulators. The other major banks all climbed higher, with Commonwealth Bank up 0.8% to $99.49, NAB rising 0.7% to $26.23, and ANZ advancing 1% to $28.32. ANZ said it expects the Reserve Bank of Australia to announce a weekly $5 billion bond buying plan at its meeting on July the 6th. A flexible QE approach will be adopted with weekly purchases of $5 billion per week, with a reassessment later in the year, the ANZ analyst said in a note on Friday. They also forecast that the central bank would hold its yield curve control program at the April 2024 government bond, rather than rolling it over into the November 2024 bond. The program, which suppresses yields on government debt, is one tool the bank has used to keep borrowing costs down across the economy. The bank also revealed data that highlighted investor lending for housing in May hit its strongest levels in dollar terms in 6 years. The RBA will also be digesting the strong housing data released this week. And ANZ said we continue to expect macroprudential policies to be implemented before the end of the year. Indeed, an informal tightening is already underway, the analyst said. Finally, gold rose 0.61% to $1,787, and Bitcoin was up 0.07% to $33,553, neither giving investors or speculators much joy this week. And talking about Bitcoin, according to statements from a senior US state departmental official, the US hopes that El Salvador will be responsible with the country's new Bitcoin tender law enacted on the 9th of June 21. The Undersecretary of State for Political Affairs, Victoria Nuland, explained that she had a meeting with the Salvadorian president and that they discussed the crypto asset Bitcoin. The American diplomat stressed that after the Colonial Pipeline ransom cases, the US was taking another tough look at Bitcoin. I did suggest to the president that whatever El Salvador chooses to do, you ensure that it is well regulated, that it's transparent, and that it is responsible, and you protect yourself against malign actors, Newland said. El Salvador has had issues getting world leaders to agree with the new Bitcoin tender law's benefits. The World Bank rejected a request from El Salvador for assistance, and the president of the European Central Bank, Christine Lagarde, recently discussed the subject with disparagement. At the time, Lagarde reiterated that the ECB's policy towards Bitcoin has not changed. Beno Cohier, head of the Innovation Hub at the Bank for International Settlements, also criticised the president's Bitcoin tender laws. In addition to the senior US Senate Department's official statements after meeting with the president, the US State Department named 14 Salvadorians that are members of the regime as corrupt and undemocratic actors. Even the economist Stephen Hanke said, "First it was El Salvador's Bitcoin law. Now the State Department is wielding the hammer." Hanke has warned that Salvadorian Bitcoin adoption could lead to a complete collapse of the economy. Moreover, Hanke and two other authors that published papers on applied economics at Johns Hopkins University wrote a paper that says El Salvador's Bitcoin law is destined to be caught in the FATF's regulatory web. Under the Bitcoin law, El Salvador will undoubtedly be ensnared in the Financial Action Task Force web of regulation. Hanke explained on Twitter, "In this working paper, I identified 27 of the FATF's red flag behaviours that will be impossible for El Salvadorians to comply with." Victoria Newland's recent comments in the US State Department's Corrupt and Undemocratic Actors report suggest that American bureaucrats agree with Hanke's opinion. And yet, also on Bitcoin, US Senator Cynthia Lummis talked about Bitcoin in an interview at the CNBC Financial Advisor Summit. Responding to the question of what her ideal crypto future would look like, she said, "I would like to see cryptocurrency like Bitcoin become part of a diversified asset allocation that are used in retirement funds and other opportunities for people to save for the future." Not only would she like to see retirement funds investing in Bitcoin and other cryptocurrencies that are good stores of value, the senator from Wyoming said that she would also like to see individuals be able to use Bitcoin and cryptocurrencies of their preference that are safe, that have met the hurdles of anti-money laundering and bank secrecy acts. Lummis said, "For me, I see Bitcoin as a great store of value. I buy Bitcoin and I hold Bitcoin." When asked about how much Bitcoin she had, she said, "Well, I think I've got about 5 Bitcoins," adding that she paid $330 for her first Bitcoin. Responding to a question about whether she invests in other cryptocurrencies, Lummis said she did not. "The only one I really understand is Bitcoin." Now, that doesn't mean that Ethereum might not have benefits as well, the senator clarified, reiterating that she sees Bitcoin as a great store of value. The senator said she currently does not see the cryptocurrency as a means of exchange, elaborating, "I want to buy and hold. I encourage people to buy and hold. I encourage them to save Bitcoin for their retirement, for their future." And she explained that this is because as the Congress spends trillions and trillions of dollars and is flooding our economy and the world economy with US dollars, there's no way that we cannot debase the value of the US dollar. So I worry about having all of our retirement monies denominated in US dollars. Lummis emphasised that one should have a diversified portfolio, so as part of diversification, having a very diverse asset allocation, so you don't have all your eggs in one basket. "I think one of the strongest stores of value for the long run is Bitcoin," the senator said. So you can decide whether you think that Bitcoin is going to be a long-term store of value, or whether it's going to get crunched by the regulators, particularly those in the US and in other central banks around the world. I think the future is generally uncertain here, so just be cautious, but you can make, of course, your own decisions. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.